Hello everyone and welcome to part 2 of our lecture on components of equity. And as you saw from part 1, we are focusing on this part of the accounting equation, the equity part. And we've learned about two accounts so far, common stock and revenue. And what you'll notice about these accounts is that they both have a plus sign in front of them. And the reason why is because they both increase equity. And that's by definition. Common stock will always increase equity, and revenue will always increase equity. So again, make sure that you pay close attention to the definitions that I have summarized here, because that will really help you in your transaction analysis to identify where the transactions belong. Now, I want to go back to where we left off on the previous lecture, which was on this revenue transaction. And to refresh your memories, that was saying that the company provided consulting services to a customer and the customer gave them cash. So we have the increase in cash here of $4,200 and we have the increase in equity of $4,200, which is revenue because by definition revenue is an increase in equity due to sale of products or services provided. So this revenue is the start of the process of how a company makes money. They make money by providing goods and services. But these goods and services don't materialize out of nowhere. You have to use stuff up in order to be able to provide those goods and services. So, if we focus on what's being used up, that's going to take away from our revenue. It's going to reduce our equity because we haven't made as much money because we had to use some stuff up in order to generate this $4,200. So let's take a look at how that is treated from an accounting perspective. Our example here says on November 7th, the company paid rent for office space for the month of November totaling $1,000. So if you look at this transaction analysis, what was given and what was received, we gave cash to our landlord. And again, the way we know it was cash is through the word paid. The way you pay for things is with cash. So unless the problem specifically says something different, if we paid in something else, which isn't very common, you're going to assume that word paid means cash. Okay, so we paid cash. And in exchange, we got to use our landlord's office space for the month of November. Now, sometimes people don't really know what to do, where to categorize this office space in the accounting equation. It's like, is it an asset? But it really doesn't meet the definition of an asset because the company doesn't own it. The landlord owns it. Rather, this is just something that we used for a period of time. We used what our landlord owned for the month of November. As you can see here, this is space with desks and chairs and computers, and we sat there and this is where they did their reports and their spreadsheets and their memos and all the stuff they needed to do for their consulting, to provide that consulting service. So again, the consulting work didn't come out of nowhere. They worked on it, and they worked on it in this space. They used this space to provide that service, to provide that revenue. So that use of that space falls under the definition of expense, which is a decrease in equity due to product or services used up in the process of generating revenue. So if you look at the transaction analysis for that, you see here that there was a decrease in cash of $1,000 and a decrease in equity of $1,000 through the expense account. Okay, so again, you see here the negative because expenses always decrease equity. We're using something up, which is taking away from revenue. But we don't show this negative in the same column as revenue because by definition, it's something different, right? By definition, revenue is increases in equity due to sale of products or services. Well, using rent is not that, and it's not the opposite of that. It's its own thing, and that thing is expense. By definition, expense is decrease in equity due to products or services used up in generating revenue. So those things that we use up are held in their own separate account category, which is expense. Now, I want to talk a little bit more about this relationship between revenues and expenses because they are indeed related. And the way it works is this. Revenues, which is the consulting services we sold, minus the expenses, which is what we used up to generate the consulting services, equals net income. And other terms for net income are profit, earnings, or that all-important question that we talked about on day one, making money. Okay, so all of these terms are going to be used interchangeably, so make sure that you have a good handle on all of those things so that in this class and in the real world, when you hear those words, you know what they mean. But it's a very important equation because it answers a very important question for businesses. Now, a few things that I want to point out about this equation is what I've shown you in the transaction analysis was just one revenue transaction and one expense transaction. But there are multiple revenue transactions every day, and multiple times a day businesses sell stuff. So there's going to be a lot of stuff in this revenue section. And expenses as well. I showed you rent, but there's tons of other things that a business has to use up. They have to use the services of their employees so that their employee costs are going to be in there. Their utilities, right? They need electricity to run their computers are going to be in there. They're going to be using supplies. They're going to be using equipment. They're going to be using all kinds of things in order to generate that revenue. So there's going to be a lot more stuff in there. And what we do is we track our revenues and expenses for a period of time so that we can see how we did during that period of time. So revenues, maybe we track those for the month of November, and then we track up all the expenses we use to generate those revenues in the month of November, and that tells us how much money we made in the month of November. And then we do the same thing again the next month in December, and that way we can compare November and December. Okay, so that's why timing is so important, especially when you're talking about revenues and expenses, because we want to know when we sold those products and when we used up the stuff to sell those products. Also, it's important to note that net income or making money has nothing to do with cash. Okay, so I have a big X through cash here. If you look at the equation, you do not see cash in it anywhere. It is revenues and expenses. So you really need to get a good handle on this concept that making money is not about when you receive cash. Okay, we're going to talk a lot more about this in the upcoming week and the following week, but the sooner you can separate those concepts of receiving cash from making money, the better off you're going to be. So I just want to plant the seed now. If you don't fully get it, that's okay. We'll talk about it more, but I'm planting the seed. So as you get more exposure to that concept, it'll make more and more sense. Okay? Net income is not receiving cash. Cash is important, and we'll definitely talk about that more later, but just know it is not any part of the formula of making money. Okay? I want to talk too about this word net. You're going to hear that a lot in this class. The word net means offset, right? We're offsetting positive and negative. And we're going to be doing that in a lot of other contexts throughout the class. I'm going to say that word net a lot, so make sure that you understand it means offsetting positives with negatives. Now, if the owners get to claim the money made by the business or the net income of the business, you might be wondering, well, when do the owners actually get their money, the money that the business made? And that is a totally valid question. But it's not that simple in business and in accounting, okay? Here's the thing, guys. Investors are external to the company. Creditors are external too, right? Both investors and creditors considered external parties, but in this particular lecture, I'm focusing only on investors. But investors are external, meaning that, they put assets into the business and they get to claim any additional assets that came in through the process of making money, but they don't get to decide what's done with that money. The people who decide what's done with the money are the managers, and that's where we get the term managers, is because they get to manage the assets of the business. And most of the time, managers really feel like, look, we need to keep the assets in the business. We need that cash. We need those supplies. We need that equipment to stay in the business so we can grow our business, right? If we give all of the money that we make back to the owners, then we're not going to have enough money to pay our employees, to pay our rent for the next month, to buy more supplies, to buy more equipment, maybe to rent out an additional office space because we want our business to grow and have more employees. So most of the time, businesses just keep the money that the business makes in the business. But sometimes investors are like, look, I gave you a bunch of my money and you used my money to make more money, so I want to see some of that money. Now, when a business decides that it is in a good enough financial position that it can afford to give some of the assets back to the investors, there is a very specific way that we deal with that in accounting. And we call that dividends. Okay, so in this example here, November 15th, it says the company paid dividends of $200 to the stockholder. So that term stockholder, again, is another word for investor or owner or shareholder. And it comes from this word stock. I think I showed you in the previous lecture, there was a stock certificate, and that stock represents ownership. So if you hold the stock certificate, it means that you are an owner. It says we paid dividends. So again, paid means in cash unless otherwise stated. So we give cash to the owners. And what ends up happening, though, is that the owners basically have to release their claim on the asset, right? The assets are no longer in the business. They've been given to the owners, so there is no asset there to claim. So the owner's claims on assets decrease. And we call that dividends, which by definition is distributions of company resources to the owners. So if you look at the actual transaction analysis, we see here the cash going down. That's the easy side. But then some people don't know what to do with the dividends, and sometimes they want to put it here as a negative in common stock. But it's not that. Common stock, first of all, by definition, is a contribution. This is not a contribution, it's a distribution. So you can't put it here in common stock, okay? We're not returning the contribution. It's not that. The contribution stays. Some people also want to call it an expense, but it's not an expense. Remember, again, by definition, expense is products or services used up in generating revenue. Well, we're not using anything up. We're just giving some cash to the owners. So it is its own unique account, and that account is dividends. And again, dividends always decrease equity because by definition, equity is owners' claims on assets. Well, if the assets go down, then the claims on the assets must also go down. Well, I hope that this video was helpful to you in better understanding these equity accounts. They are definitely the most confusing out of all of the different types of accounts, but I hope that through this video it helped explain stuff. Of course, if you have any questions, please bring them to class and I am happy to answer them in more detail for you. Thanks a lot.